Hello everyone, welcome to Fearfully Greedy. In today's episode, I will just do a quick update on Carvana after the recent earnings and the announcement about the offer for the debt. And also, since it has moved a lot, like over 400% in 100 days, now it's kind of an important position for the portfolio. So since the last video, I haven't done any trades, no addition, no capital raise, anything. Remember, this is not financial advice. Please run your own numbers. I do hold this position, so I'm biased. Do your work or get a professional. We'll talk about a few things. First, I wanted to start talking about the improved profit that we have seen. EBITDA took a dive in 2022, and in the first quarter we saw positive signs, still very underwater, even EBITDA per unit or otherwise. And in the second quarter, the positive signs keep going, and we're a bit maybe back on track or maybe a bit on track. But remember, at much less units, this would be annualized. So we're at 320,000 units per year. As we'll see, we'll need many more units. Okay, there are some things impacting these extra profits, extra margin that we have seen. Some are non-recurring, some are recurring. The first one is since they had more receivables, more loans held for sold, they had higher earnings on that loan, and then also from selling them. So that has affected $650 per unit, okay, of the 7,000 or whatever it was, whatever unit you wanna take in. And then retail inventory allowance, they took like a reserve in last quarter of 2022, and it turned out they did a bit better. So there's a $250 per unit also increase. Then other positive factors. First one is that Q2 tends to be the best one for everyone, so it happened. Then there have been high spreads between what would be wholesale and retail, so they would buy cheaper and sell higher, which is not always the case, which should be lower spreads. Then there are some long-term, they would say, improvements. The first one is that they have the right inventory size for the amount of units they are moving. So less depreciation, the less cost of just managing all those many vehicles. Then they have a higher percentage of cars being acquired from customers. They also have additional services, which, well, I wouldn't think much about that because nationwide shipping, home delivery, so maybe they are moving farther cars that people want and getting some margin from that. Then those ones, they think they are fundamental also, which is that the cost of reconditioning and internal transport, they are lower than 2021 full year. And even since they got ADESA, so ADESA was a running company before, ADESA makes a profit, so some of that profit will keep going, okay? Then I wanted to go into the improved cost per unit. If we see SG&A, we would see that from March to now, we had almost everything. Advertisement would be like flattish, but almost everything still going down a bit. So they still think there's some room for even improvement, but 450 million on this quarter against 472 million in last quarter. If we see the graph, we can see that, yeah, it keeps going down for most things. Advertisement is kind of flattish. It's ticked up a bit. In the call, they said that some of the items in the other move around a lot quarter by quarter, so sometimes it can be higher or lower, but in general, it should be trending down. We'll see in the next quarters. Next, I would like, of course, to talk about the debt situation. There was a huge news. So if you remember, that was the bad part of Carvana, a part of losing volume and everything. But if you remember, the interest expense was now running at 159 million per quarter, which it's over 600 a year, so it's a lot. And then with the first quarter, let's say the more liquid resources, which would be cash and then the short-term revolving facilities, were already at 1.5 billion. So if we did some numbers there, unless things improved a lot, they would be broke pretty soon. And then maturities in 2025, they have to come up with 500 more million. So it wasn't looking great. Okay, so there was some news. They agreed with 90% of the senior unsecured notes holders that they would like push the can a bit down the road, so make new notes, and they would have lower maturities now and have them later for an increased payment. I will run you through the numbers, but yeah, for the next 2 years they have lowered by 430 million per year, which should give them like a 200 million interest expense for the next 2 years. The maturities also go down by 83%. That's with who they have agreements. Now extra people can like come in with their notes, and they also have like a deal that they could borrow some extra at the same basis or another basis. Okay, so there will be 3 tranches that they have agreed with them. The first one would be like shorter to longer duration and less payment to more payment. Okay, the first one would be around $1 billion if it goes to 100%. And first, it's 12% payment in kind, which would be that you defer the payment and it increases the amount of the loan. So let's say when it goes to cash, it will be to that initial amount plus the 12% of the first year, and maybe if you want the second year, so 12% on that added 12%. So the numbers end up being pretty much the same, as we'll see in a minute. There's another one which will be 1.5 billion. That's a bit higher interest to pay, and also first one has to be PIK. The second one can be you decide. The third one is cash, and thereafter. Then the last one is 14% for 1 and 2 years for sure, and then after the third year, 9% cash. It's 1.875 billion. If we take the PIK into account, that goes much higher. But so those were the notes that they would have on June 30, 2023, which, as you see, maturities on 2025 would be in October. They would have to repay the 500 million. Of course, the interest is much lower, but they wouldn't have this money unless things really improve very soon. Then 600 in 2027, 600 in 2028. They don't say exactly which ones are retiring and which ones not. So I took the numbers and I tried to run through it. In general, these ones would be out, only very small remnant. Most of these also will be out because there's a higher payment like later on. So what they came out is with these new 3 things. Okay, I left some remnant here on the bottom, but this 100% wrong. So don't take this, but would be approximately right. They also have to come to some cash to retire these notes early. They have to pay some cash to the note holders, which we don't have the details yet. Yeah, but we'll see, and that's the minimum requirement of equity raise. The Garcias would take a third, more or less, of that. If they can raise over 700 million, then it would they wouldn't have to add those 120 something million they are adding. I hope we don't get diluted a lot, but 350 million, well, we'll get some dilution either we want it or not. I said this comes with 12 PIK, like first year, second year you can PIK. This first year for sure, second year you can PIK, you can decide. Then 14%, 2 years, and then after 9%. If this just, in a sense, pushes the thing down the road. Of course, if I'm wrong, because PIK you can pay in different things, not just by the amount of the loan. Not just in the same loan, it could be stock or other stuff. So if I'm wrong, please tell me, so I would adjust my model. But yeah, maturities, if you see, we would have the ones we were talking about. And now virtually in 2027, it's just much less cash, it's 350 million. and then everything is thereafter, so 2028 and so. So it's just taking some of these cash that they wouldn't have at that point and just kicking the can down the road. If we end up counting everything with the peak interest, they would just increase the debt amount, we're not improving much. They say that they reduce 1.2 billion in debt, it will be nothing. With my numbers, if I'm wrong, you let me know. Okay, interest payment of course goes down a lot, it changes, I said we push the can down the road and we pay for more years. Okay, so but in 2023 we'd have to be paying 636 million, and of course we're half of the year, so this year's know that it's June to June, but yeah, now we would just be paying 200 million more or less, and then after 2025 second half around 600 if my numbers are right, and then 4 more years. Okay, will that make Carvana survive? We'll see. Let's see what numbers should be for us to survive. Okay, this was the model I gave you. I told you this is probably wrong, or well, it's 100% wrong, but it's a possibility. Okay, 75,000 units and running at 10% per quarter, so growth per quarter, which is over 40% a year. So I don't know, pretty delusional. Maybe not. They have done this growth before, but I don't think that's happening anytime soon. Then I said 5,000 GPU Q2, which was better, 4,300 GPU after, which I think now seeing a bit the numbers should be better, but the growth should be lower. So let's adjust, and I said this will be wrong, but 75,000 units after, so after the second quarter, so this will be for third quarter, and then I fix the GPU at 5,000, and then I fix the SG&A as I had done before, which completely wrong, because sure they can do a few extra cars with very similar SG&A, but if they sell double the cars, the SG&A should go up. So this is not wrong, but in this scenario, if this was possible, Carvana is free from any trouble. Of course, we still have to grow over 220% a year, which is pretty ridiculous. Okay, another estimate. This one takes into account that for every extra unit, we have 50% of the current cost per unit on SG&A, which is high or low, I don't know, but just at 5% growth, this doesn't cut it. So we need to know what numbers would make sense, what numbers wouldn't. So to clarify, this 50% extra unit cost would be if to sell 100 cars, we have to pay $100 in SG&A. To sell 200 cars, a 50% increase would be we are paying $150 to sell the 200 cars. I hope I made some sense. So this doesn't add up. So let's see if we can increase the growth, and at 10% per quarter, so over 40% a year, this works. Okay, this we never go broke. We are positive at, well, very early on. Of course, the dotted line is units and it's on the right axis. Okay, so this one is the final one I did. It's probably wrong, but it shows that it's pretty close to going bust a few times. 76,000 units, same, but 5% growth per quarter. Fixed 5,000 GPU, which could be higher, could be lower. SG&A, I picked at 40% per extra unit. I think maybe this is not linear, because at some point you have to get a new lot or a new market, or like you have to buy a lot of things. But in general, like if we do 300,000 cars, they should be spending, I don't know, close to 800 million SG&A for those cars, more or less. That's the model. Do your own numbers if they seem to make sense. Of course, you can see here the maturities. This takes into account all the peak, like if everyone would take peak instead of cash for the first 2 years. It's still looking close, because if you see like the liquidity would be like at 500 million of liquidity for a few quarters until we're pretty close to having positive cash flow. We get to positive cash flow at 150,000 units, which was pretty much what they said before. So this doesn't change much because this is already, so we get 2 years to get our things ready, and then we need like the growth to take off. Okay, then, sorry. The receivables, I told you they were high. They have lowered them a bit, so that's as we saw in the extra gross profit. And if we see that was what happened in the first quarter, we would have like 6 times the number of receivables to revenue, receivables held for sale. And now they have lowered it a bit. Still elevated, like 3 times as elevated, but not 6 times. So they should still have it a bit lower, but less worry in that sense. Okay, they are guiding, just to finish, that they will do similar retail units on Q3, so 76,000 more or less. They expect over 5,000 GPU per unit, GP per unit on the Q3. They also expect that the G&A would be flattish, and they think they will have positive EBITDA in Q3. So pretty similar numbers to this quarter. That's what they think. They also say that it's very early in the quarter to give any proper outlook. So we'll see. We'll keep an eye on it, but we still need 3 more months to see this. The portfolio now is looking like a meme portfolio, or I don't know how you say it, but okay, Carvana now it's 25.7% of the portfolio, over 10,000 euros. Okay, this is positive, so we're back to positive on annualized, and we're 4,500 euros positive. There are positions that I should rate at 0, but the 0 is not going to rate it at 0, so I don't know exactly what to do, how to price it at 0, so you can see the same number at the 0, and it doesn't confuse everyone. But this is the portfolio as of now. I will keep you updated with new positions and maybe a few updates on the current positions. Okay, everyone, take care, be safe, bye bye.